new friends, new opportunities, new partners. EG Tax.
And here's Esther.
Okay, everybody, I'll tell you what we're doing here. I'm going to be doing business tax reform, and I just want to thank you for coming, right? So, but the 20% pass-through, it takes all of your businesses, all of your rental properties, all the real estate investment trusts that you're involved in, puts all the net profits together. That is then multiplied by 20%, and that's a deduction after your standard deduction. So if you had $100,000 rental income, and that were the only income that you had for rental property, then you'd get a $20,000 deduction. And if you're in the 20% bracket, you save $4,000 in taxes. So that's brand new. So it's your total adjusted gross income minus your itemized deductions or standard deduction minus the 20% pass-through. Okay? Now, yes, sir? Okay. So, now here's the only other thing with the rental property. Because rental property many times with the depreciation makes you operate in the red, many of you who have thought maybe about refinancing because you can write off the interest on your rental property may not want to do that because maybe you want to have your rental property operate in the black so you can get the 20%. And by the way, if it has a loss, that loss offsets other gainers. So if this rental property had a $2,000 paper loss because of depreciation, and this had a $3,000 gain, the $2,000 affects the $3,000, so you only get the pass-through on the $1,000. So you'd only get 20% of $1,000. All right. Now, if this year, because you didn't know, and let's say you've already got your rental property set up in such a way it's going to produce a loss. Let's say this year's loss is $10,000 on all your rentals. Next year you maybe buy some other piece of property and you've decided to not finance it as much so that you can produce a net gain, and you're going to do something else with you're going to have that money operate in another way. That loss from this year, 2018, is going to carry forward to next year. So even if next year you have a $20,000 gain on a new piece of property and you have the loss from last year, that's going to be carried forward to next year, and you'll only get the 20% on the net after the pass-through carry forward. Sound easy? So the bottom line is, if you have rental property, you don't want to necessarily take these larger expense items because they actually are going to cost you 20% because you're not going to get a pass-through. So those are things you have to tax plan about. And the only way you can tax plan is to put pencil to paper or computer to printer or whatever. Yeah. Yes, right, and the rest is suspended. So, but that whole loss is what's carried forward to the next year. Okay? Questions? Okay. So the expensing, again, you can now, it used to be the maximum was, and this year, starting the maximum is up to $1 million that you can expense. So those of you that have small businesses, again, you can take up to $1 million as an expense item. The thing is, though, if it makes you lose money, you maybe want to say, because if you expense it, means you can't write it off anymore, right? It's because it's already been written off. Well, if it ruins your 20% pass-through, maybe you don't want to take 100% expensing. Maybe you want to spread it out a little bit. Okay, and remember, all of your losses affect the gainers. So you want to make sure that if you can get to a gaining position and still have your depreciation carry forward to other years, that may be the better way to operate, because you don't want to lose that 20% And again, bonus depreciation. So you can see what they did was they said, if you have the asset and you want to take everything up front, we're going to allow you to take it up front. So there's many more things that you're going to be able to write off using 100% expensing. And your automobile that was limited before where they called it, what's the word?
Luxury.
Yeah, luxury. Luxury vehicle expenses have been increased, so they allow you to write off more. But again, the more you write off, the smaller your 20% is going to be. So you really do have to plan for that, because you don't want to lose that 20% deduction.
And it's not like you lose the depreciable, like if you don't take it now, you don't lose it. You still have it for the next year. It could be
Right.
5-year, 7-year property. So you could save money now with taking it all and lose 20%, or possibly get the 20% for the next 7 years.
Right. So the thing is, many people are tempted to say, well, I just don't want to pay taxes. Okay, that's true. And in order to do that, you can make an election to say, I bought all new refrigerators and stoves for my rentals. And what I'd like to do is write it all off. That's great, then you won't pay any taxes. But all those stoves and refrigerators have been written off. You can't write them off again. So it means there's nothing for next year. And you lose the 20%. Yes, sir.
So, I get this. So what about assets placed in service? I'm trying to read this. So,
Oh, you have it in your little book.
okay.
This, it makes it even smaller.
So I started depreciating. One's not working. So I started depreciating some assets that I placed in service in 2015. Okay? Now, because of this strategy, am I allowed to suspend the depreciation on that?
You can't suspend, but you can make an election to change the method of depreciation to a slower method.
Okay, to a slower method.
Right.
So I can't
But if
just
it's
say
all
no.
if it's already been written off, there's nothing you can
Right,
do.
completely. But if I'm in the middle of it,
Right.
I could say, well, I can't just push it aside, but I can say, instead of 7 years, we're going to make it 10 years or whatever.
Well, actually, instead of being 7 years makers, it might be 7 years straight line.
Got
or
it.
whatever,
Whatever.
some other method.
Whatever that slows it
Something
down.
to slow it up.
Okay.
But again, you got to put a
Yeah.
pencil to it. Yeah,
Sure.
Chris. Okay. Anybody else? But here's the other thing. With the 20% pass-through, you might just want to say, you know, I have these rentals that are, I already got them all set up, and they're already maybe close to getting paid off. They're going to be making money here in the next few years. Maybe you were thinking about refinancing them. Maybe now you don't want to refinance them because of the 20% pass-through. Or maybe you got a small business that you were thinking of expensing a lot of the things that you bought this year, and maybe you want to slow it up because of the 20% pass-through. So, like Chris says, if you don't expense it, if you don't take accelerated depreciation, it's still there to use in the future. But if you write it off, it's true, this year you won't pay taxes, but you've given up a 20% deduction as well. Plus, that loss gets carried forward to the next year. So it's a problem, yeah.
Is that on the basis of a C-Corp?
Oh, okay, so we're going to get into those in a sec, okay? Because this S-Corp is, on a C-Corp, all corporations start off as a C-Corp. But you can make an election to have your C-Corp be taxed as an S-Corp, which would mean that it carries through to your personal return. C-Corps, the maximum, our flat rate on all C-Corps this year is 21%. So if last year you had a C-Corp that was taxed at 10%, you will pay 21% on your C-Corp this year. So it's an increase in taxes of 11%. If you have, and if any of you have corporations? Okay, if you have a C-Corp, I'm going to look at you. If you have a C-Corp, you really want to take a look at moving to an S-Corp. That's another thing, change in the tax law this year, that they've liberalized Cash, you can use cash method of accounting rather than having to do an accrual accounting or some other method of accounting. So that's another reason to move to an from a C Corp to an S Corp. But if your C Corp last year was at the lowest rung, or you had a loss, the only loss that you could have taken is to offset the future earnings on your C Corp. If you move to an S Corp, you get to take it on your personal return, and it would be taxed at whatever your tax rate is on your personal return, if it's an S Corp.
And
No, you have to carry forward those losses, and they adjust the basis. So.
you may want to talk about the double taxation of a C Corp.
Oh yeah, and then a C Corp is doubly taxed. So not only is it at 21% this year, let's say last year you were in the 10% bracket on your C Corp, you're going to pay 21% in taxes, flat rate. And if you want to take the money out, they're going to pay you a dividend, and you have to pay taxes on your dividend on your personal return. So if you're a C Corp, and many times accountants will set up businesses as a C Corp, and they really should be an S Corp. And you can make that election and switch it like that.
I'm sorry. One thing you hear all the time, at least in these seminars we've gone to, is you should now switch from an S Corp to a C Corp. And we sit there going, why? You know, why would the government want you to go from an S Corp to a C Corp? Because you're going to pay more taxes.
Right, double taxes.
Right?
Right.
I mean, so if the government's telling you do something, go the other way.
All right, so the 20% pass-through, everybody understands how you get it, right? Now, there's a little caveat. If you have income over $207,500 adjusted gross income, or $415,000 and you're married filing a joint return, then the pass-through, the 20%, changes how you can take it. So if I mean, I would say probably most people in Buffalo would come comfortably under the $415,000 cap, but if your income exceeds that, then the 20% pass-through is limited. So, or you might not get it at all. And the other thing is service businesses such as tax accountants, doctors, lawyers, who else? CPAs, financial planners, dentists. If their income exceeds married filing joint $415,000, they can't get the 20% at all, no matter what they do. However, any other non-service business is, if their income exceeds the $415,000 married filing a joint return, then they would get either the 20% pass-through or 50% of the wages that they had, or 25% of their wages plus 0.025% of their unadjusted basis of their assets, or number 3, 25% of your wages paid plus 2.5% of the original basis. That's the 3. So if you have $500,000 corporation, all right, that does widgets, all right, it's the net profit's $500,000. 20% of the $500,000 would be $100,000 pass-through deduction. You could take that, or you could take 50% of your wages, which would be if you had wages of nothing, then you wouldn't get any pass-through, or 25% of your wages plus 2.5% of your unadjusted basis of your property that you had. So if you had property of $2 million, that's what you would take, and 2.5% of the $2 million property would be $50,000. So you'd either get the $200,000 or $50,000, whichever is less, and so it would be $50,000. So that would be how the pass-through deduction would work if your income exceeds $415,000 and it's not a service industry. And the thing is, it goes back to if you're going to pick the thing without, and it makes people think about, you need to have wages in order to take the pass-through if you have a highly profitable business.
And it's,
yes.
We got to run up there.
Would a transportation company be considered a service company?
No.
Okay.
You're good.
Okay.
You're good. But so the thing is, and the other thing is, since it's, let's say that your transportation company is making $300,000. So you know you're good to go, you're going to get the 20%. So you'd get a $60,000 deduction, all right? But let's say the next year the transportation company may, and let's say you didn't pay yourself any salary, because many times corporations have a tendency to not pay the owner of the corporation a salary, which we're going to get to. But the next year, let's say it makes $700,000. Oh, so it's 20% of the $700,000, or 25% of 50% of the wages I paid, no wages, or 25% of the wages plus 2.5% of the net asset value. And so let's say your asset value is $1 million, so you're going to do 25,000. 25,000 is the lower, so that's what I'm going to do. But because you haven't paid yourself, I'm saying you, a salary, they're going to come audit you, because all corporations have to pay a reasonable salary for services rendered to the owner. And with that 20% pass-through, it's such a, because it's 20% of your net profit, you think, well, good, I just won't pay myself a salary, I'll make my net profit higher. As long as it's under the 415, it'll give me a bigger pass-through. No, that will get you audited. Yes?
We have several companies, and one of our partner companies is an administrative company, and actually we process the payroll for that company and we bill it to the other company. This is how we've done it previously. Now, my understanding, in order to get this deduction, we actually have to set up
You
a
have-
payroll company and the other companies, it actually has to be paid directly from them.
That's, well, no, because actually they were talking about, at this seminar we went to in Atlantic City, that if they can track how it went, it's okay. As long as there's a track record, it's okay. But again, a lot of this stuff is being written kind of as we speak, and this was their best guesstimate of how it should be done. But I will tell you something, the payroll company would be considered to be a service company, and so why would you do two companies? I mean, why would you?
Well, we have like 3 different transportation companies.
Okay.
And the one company really doesn't have any employees, and we previously did not pay a company, but over the last couple of years we have paid wages and then actually billed it to that company for,
Well, remember now, if it's considered a service company and your AGI on your tax return exceeds 415, then you're not going to be able to take any of the loss, any of the gain as the 20%. So you might want to rethink the whole structure of everything.
But initially you said that transportation facilities are not service.
No, you said you have a payroll service.
No, she uses, Company B pays Company C's payroll.
Oh, okay, so you don't have a payroll service. Okay, I misunderstood. Yeah. Okay, that's fine. That's why I thought, why would you have a payroll service? I thought you had a company that was a payroll service.
I'm just going to say, just be careful when you have Company B paying Company
Yep.
C's bills or Company A's bills, because if Company C gets audited,
Yep.
Company B, guess what, is getting thrown in the audit.
Yeah.
And then Company A. So you got to make sure you have good records.
The bottom line, everything's so substantially changed under tax reform that some of the things that we did automatically before, maximizing deduction, isn't necessarily the same. And some people that had service in businesses, because sometimes they have this one do rental to that one, sometimes keeping it simple, stupid, because that's really what they're saying, let's make it more easy to follow. You want to make sure that it's in your best interest. You want to sit with your accountant and make sure that it's all done so it doesn't get audited.
But it's also subject to more tax levy, more simple by like unemployment taxes or comp taxes. If you meet certain limitations, when you carve it out and now have a payroll through the direct company, then you're duplicating some expenses that you would not need.
Well, again, we can't talk, right here, but maybe if you would like us to look at it, we'd be very happy to, or sit down with your accountant and make sure that under tax reform, that this is the best way for you. Okay?
So, I'm sorry.
Yeah.
We're talking right now, Esther's talking income over 400,000. Let's talk about the small S corps, mom and pop who have an S corporation, and it's just one owner and he's not paying himself. They're now enforcing that corporation, that profit is subject to self-employment tax on the owner of the corporation. So you're thinking, I'm going to avoid paying Social Security by just keeping it an S corp? The government says no.
In other words, you have to pay yourself a salary.
Yep.
And if you haven't paid yourself a salary, then they make you allocate what the salary should have been.
And if you're the only person working, it's all self-employment. So if you have no employees.
That's right. So if you have an S corp and you have no employees, then the whole net profit is subject to FICA. Because in order to do an S corp and not pay FICA on the entire net profit, you have to have other employees that are helping to produce the income. So, all right, but the bottom line is everything that you used to know from when you're having a business, whether it's rental property or small business, whether you have a C-Corp, whether you have an S-Corp, the bottom line is the C-Corp is going to pay at 21%. They're allowing you and giving you the option to move to an S-Corp and become a cash basis taxpayer as opposed to somebody with a hybrid method of accounting or accrual, and I would strongly look at that. If you have a business, you want to make sure that whether it's a C-Corp or an S-Corp, to make sure you're paying yourself a reasonable salary for the services you render. Otherwise, you could find yourself getting audited, and because it's giving you a pass-through deduction that you shouldn't have. If you have rental property that's been operating at a loss, those losses carry forward. If you don't have any net income this year, to have it offset. And if you have a business and rental property, this loss is going to affect your pass-through on that. If your income comes over between $315,000 and $415,000, there's a phase-out at $415,000. You no longer get the 20% unless you have wages or asset value. And that's going to, and it requires you if you have no wages that your business paid you or paid anyone, that your 2.5% of your unadjusted basis goes back to what you originally paid for the asset. So if your book value right now on a truck is $5,000 and you paid $100,000 for the truck and the book value is only $5 now, the 2.5% goes back to the original basis, so you have to go back and find out what you actually paid for assets. And so if you haven't been carrying forward your depreciation properly, it means that you have to go back before tax time and figure out what that basis is if you're looking for the pass-through. Okay? Anything else? Good. Questions? Yes, sir. Get up there, Chris.
I can talk. Got to make sure it goes on the mic.
Okay, in general terms, we chose to sell 4 of our income properties this year and retain 2. Am I correct to maximize 20% or whatever? Am I correct in my limited understanding that we're better off paying off the mortgages on the other 2 than paying off our residential mortgage?
Yes.
Thank you.
Because on your residential mortgage, it's going to be, it all depends on whether you can itemize, but even if you can itemize, let's say you could itemize at $27,000 and your standard deduction is $24,000, you're only getting a $3,000 benefit. But let's say that on your rental property, though, you end up with a net profit, and you're going to get a 20% deduction on your net profit. So actually debt is not king under tax reform, because they're really not doing you any deal on debt, whether it be itemized or on your rental property. You want any rental property or small business to produce a profit while maximizing your net profit without killing your tax bill. So you really have to look at it and say, okay, if we do this, your tax bill's going to be this. If we do this, your tax bill's going to be this. If we do this, your tax bill's going to be this. And you really have to plan and see which works out best for you. But debt, no matter what debt it is not a great tax strategy if you don't need the debt. If you have to do the debt, that's another thing. Yes, anybody else? Good, good, good. Yes? Okay, hey, thanks a lot.
New friends, new opportunities, new partners. E.G. Tax.